Welcome back to the Sustainability Talks podcast. I'm your host, Patrick Sheehan, Managing Partner at ETF Partners. ETF Partners is Europe's oldest and leading venture capital firm focused on backing businesses that deliver what we call sustainability through innovation. Last time we spoke with Lord John Brown, the ex-CEO of BP. He shared his insights and predictions on the future of energy in a world going digital. It's a fascinating episode, so do make sure to listen if you haven't already done so. In today's episode, we'll be speaking with Vikram Gandhi, professor at Harvard Business School, to discuss investing, risk, reward, and impact. Leading this conversation are my co-hosts and partners at ETF, Rob Genieser and Remy de Tonnac.
So again, welcome, Remy, my partner at ETF, and also Vikram. I think we should first start by introducing Vikram. So Vikram I've known for over 30 years. I was a bright young kid 30 years ago coming out of Harvard, and I was starting as a financial analyst at Morgan Stanley. And there was this impressive graduate from Harvard Business School who was my associate, none other than Vikram Gandhi. After 23 years in investment banking, both at Morgan Stanley and Credit Suisse, I think you were in New York, I think you were in Asia, and spending a lot of time actually in India. You've gone back to teach at Harvard, which is fantastic, the Harvard Business School. And you have a lot of stories to share, and you're heavily involved with lots of different things right now, from being a senior advisor to the Canadian pension plan, to also teaching at Tsinghua University, the business school there, and finally doing a lot of impact work in India. So it's very impressive, the career that you've led. And frankly, this is a great moment for me because as a graduate of the Harvard Business School, the professors there used to always ask me a lot of questions. And I finally get the question of Harvard Business School professor. So this is just fantastic. This has really made my day.
This is like the cold call moment for you, huh?
Exactly. So I'm really pleased by this. But I was going to start. You had three optimists on the last panel. There's a wall of money. There's a will to deploy that money. But come on, Vikram, you're somewhat cynical. You're sitting in the United States today. Do you really believe in all this, or is it somewhat overhyped?
First of all, Rob, thank you very much, and to ETF, and I really appreciate the opportunity. I think there is a fair degree of skepticism. I mean, clearly there's a wall of money. There's an understanding that these are major issues that need to happen or need to be dealt with. But the issue from my perspective is that are the risk-adjusted returns there? The kind of facilitating environment from the government, from the policy perspective there to encourage investment like this. And so I think that clearly there's been a lot more money that's being channeled towards this, but there clearly remains a fair degree of skepticism as well. And I think that's what we need to kind of deal with. We've seen in terms of data, over $30 trillion of assets under management now have some sort of an ESG overlay, which is fantastic. I mean, that's the size of the equity market in the US. So the numbers are big. But if you actually break down the 30 trillion, 20 trillion of that is negative screens, which is people not investing in certain stocks that they don't like, as opposed to proactively allocating capital towards productive exercises in terms of new energy and so forth. We are making tremendous strides in the right direction. I also totally agree with the fact that you've got to have a public policy posture, like Uli and Christian talked about, which encourages private capital to come in, and that's very, very critical. But we need more private capital to come in, and I think that's still not happening in a more proactive manner, as opposed to negative screens. I just don't want to invest in this, so I'm going to move on.
Listen, so I understand that you really literally started the impact investing class at Harvard a few years back. Don't you think that we have a problem with ESG and impact investing? Meaning, for as long as we use the word of impact investing, then it means that this is perceived as a sideline or minor class of asset management. And we will have only really succeeded when it will be investing. That's it. And meaning ESG and impact will just be embedded, So when do you foresee that to happen?
Yeah. No, that Remy, thanks for asking that question. So when I got involved, so let to focus on the academic side, since our last speakers were looking more at the macro government side. Even in my mind, actually educating younger folks to appreciate everything that's happening in the world and the power that capitalism and private capital combined with government policy and philanthropic capital can play. And I want to emphasize that all three of those areas have an enormous role to play to come together to make this happen. This is not a one solution by one source of capital. And my whole philosophy was that can we not really bring more awareness on the part of young leaders, like I say at HBS, we educate leaders that make a difference in the world. Rob is one of them. And there are a few others on the panel here as well. Is that can we not bring much more awareness on this topic to that? That's how I got involved with HBS 5 years ago. I developed a whole new course, and we call it Investing Risk, Return, and Impact. We consciously stayed away from calling it an impact investing course. And I know a lot of funds, including like ETFs, have stayed away from the word of impact, because as soon as you talk about impact, it's like, oh, there must be some subsidized returns. There's an element of philanthropy. There's this, that, and the other. And so I totally get that. And I'm not trying to knock philanthropy. There is a massive role for philanthropy here. But if you're trying to bring in fiduciary capital, institutional capital, which actually cannot be sacrificing returns for the greater good, so you got to be focusing on an investment thesis that brings both risk and return. But then we brought in impact as well, saying, look, do we actually need to sacrifice returns and bring in impact as well? So the whole course is called Investing Risk, Return, and Impact. And you're absolutely right. The question is, like, why does impact, ESG, be this little silo on the side that needs to be brought into a course? But I think for all the folks who are on the call here, and for all of you, when you try to bring in a new concept, if you try and just bring it in from the top down and like jam it into everything that's being done, it probably doesn't work. So you incubate it on the side, you experiment with it, you develop a lot of data which suggests that this actually works, and then over a period of time you integrate it into the mainstream. And that's my goal. I mean, I say this very openly that, hopefully 5, maybe it may take longer, but 5 years from now, my course is redundant. I mean, there shouldn't be a course like this. It should be in every investing course, in every operating course. How you think about ESG, how you think of impact is an integral part of that course. And my course should just be like written off. And that's my goal, actually, is to write my course off.
Well, Vikram, I won't write you off just yet, because I have a few more questions. But when I'm thinking about risk, reward, and impact, I think about measurement immediately. And in the last panel, Ueno-san from Komatsu had a question around how you should think about measurement. And he was talking about the Danish Growth Fund. Should you focus on the amount of CO2 that your investments are abating? Should you think about the number of jobs you're creating? Should you think about GDP growth, right? I guess we can also say the same thing about a pension fund investor, the different metrics that he or she should be looking for. When you're teaching this at Harvard, how do you think about measurement in the context of risk?
No, so in our class, we've got 5 modules. We have an introductory module, and this is for the MBA class. And actually, just for the benefit of this audience, we're developing a HBS online course, which will be ready in the next 12 months, just because there's been so much demand for it. For executives, for financial advisors, and for others, and that'll be kind of in a more online module. But as far as the MBA course goes, we've got 5 modules. We have a module which deals with an introduction, then a module on private markets and how do you invest, and that's where we have a wonderful course on ETF and on e-leather. So just for the benefit of the audience, we wrote it. I usually you use your HBS alum, and in this case, I said, "Hey, Rob, you owe me one. I need to write a course on one of your investment companies." So we wrote a case on e-leather, and it's actually going to be really interesting to teach that case this coming semester, which we will. They had a massive upturn, and now you got the airline industry, and like what happens, and still they're doing wonderful things, but like what happens in a company like that? So it's such a fantastic kind of learning experience for the students. So we have a private markets module, and then we have a public markets module where we talk about generation and CalSTRS and some of the large pension plans and engagement. And then we have a module on measurement. And so to your question, measurement is a very interesting topic, which we've dealt with a lot. And we've got like a whole spectrum, right? So we've got a case which deals with RCTs. I mean, you can go down and do a randomized control trial on any intervention that you have. It's probably the gold standard. It takes a lot of time and a lot of money and over multiple years. That's one. The second extreme is, hey, this feels like impact, so it must be impact, so I'm an impact investor. And a lot of family offices go that way. And then there's a whole spectrum in the middle. I mean, I think, correct me if I'm wrong, and you should correct me, but that what our case on ETF talks about is that you'll try to do some pretty deep impact analysis, try to figure out like every investment, how is it actually going to impact the environment, and then realize that just too much work, and it just doesn't, the return on the effort involved is just not there. And so you're going to make it, scale it down a little bit. So we actually are very clear and conscious that the fact is that whether you're called an impact fund, ETF's not called an impact fund, and lots of other kind of cases that we write are not called impact funds. But is there an intent, in addition to generating a market-based return, is there an intent to move the needle on an important societal issue? And if there is, in my mind, that's an impact fund. And then the next question is, well, just like you measure your returns, how are you measuring your impact returns? And equally importantly, how aligned are you with the entrepreneur that you're investing in to achieve that? And I think there's no right formula for that. There's no right answer. It's a whole spectrum. And I think you guys appreciate that more than anybody else, because I would say that you probably are more on the lighter side of the spectrum in terms of figuring out how impactful your investment. I may be wrong, so correct me. Versus some others who are more like, I need this report and I need this, and that's how I'm going to report to my board, and that's how I'm going to, get back to you with additional investment.
Yeah, I think actually, Vikram, it's a bit of a journey, right? As you were saying,
Yeah.
So in the early days, it was very meticulous, but it would bring false answers. So I think, you have to be very careful of applying some very extensive methodology that produces the false result. And as you said, we went to a more, okay, what's the big impact that we're trying to achieve with these companies? Now we tie everything back to the UN sustainability goals, and we have underlying metrics for our companies. And I think that's been the right approach for us. And it turns out we're still leading, I would say, when it comes to how a lot of people are looking at things. But
right, and you have to have a balance. You got to deal with your LPs, a lot of whom are on the call here and want to get some report. You got to deal with what's important to you as a fund management team, and then also from the social entrepreneur. I mean, you got to be aligned with what their mission in life is, but also not overburden them with, you got to report on this, that, and the other, and they spend half their time figuring out how to report to you as opposed to running their business. So I think it's a very fine, delicate act, and you got to draw a balance between the impact diligent, the hardcore impact people versus the more lighter, and then just try and figure out the balance there.
And Vikram, even before we talk about metrics, don't you think that we have a bigger problem with capitalism in the way we assess value creation from an economic theory viewpoint? So it's a long and a very big question, which means that the economic rule and the economic calculation as it is taught in business school were developed long ago, more than 2 centuries ago, by David Ricardo and the French guy, Jean-Baptiste Say, first liberal economist to theorize value creation. And they basically started from the assumption that natural resources are infinite, so no need to amortize them, and that there is no cost of any kind of externalities, which is, by the way, a very bad word to describe the way we kill the planet. So there is no need to provision for these damages that we are doing. And so in a way, it comes back to Patrick's question earlier on. Is capitalism right and legitimate to help solve this Armageddon challenge that we are facing today? And you, as an economist and Harvard teacher and policy advocate, what do you think? What do you want to do about it to try to change drastically this rule?
You know, the fundamentals of capitalism are still alive and well, and I would subscribe to that as well. But they need tweaking. You know, one of my colleagues, Rebecca Henderson, has just recently written a book called Reimagining Capitalism. And it wasn't about, like, I got to nix capitalism. It was about how do we reimagine it. And I think the reimagining of capitalism is exactly what you said right now, Remy, which is that, you know, it's not a freewheeling kind of environment that you operate in. There's a reason why you have taxes. There's a reason why you have rent. There's a reason why all these economics things that exist. But it's only the last 40, 50 years. It's from the 60s when emissions, let's take, since this is ETF is a very climate focused organization, is that it's only in the 60s where the emission levels have so skyrocketed with absolutely no taxation on them and no cost of the externality, that it's created this what Mark Carney calls is this tragedy of horizons. You know, it's a classic tragedy. If you go through economics, it's the tragedy of the commons problem. It's everybody's problem, but it's actually nobody's problem in the near term. And so it's nobody's real problem, but if the problem keeps on eating away, it becomes everyone's problem. And the tragedy of the horizons is just a different kind of evolution of the tragedy of the commons, which is that you have a generational horizon. And so what I'm very encouraged about, just to be clear, including my own children who are in their 20s, is that they are not sitting back. They are pushing. They are pushing from a variety of fronts. And it's not about saying, oh, we need to become socialist or we need to change our system of government or anything else. It's about there's got to be a different element as to how corporations hold themselves accountable. And the way they're doing that is multiple fold, right? Most of these people are customers. You know, you see this big trend of folks buying things which companies actually are much more conscious about what they're doing with the environment. They, in our recruiting and our interviewing process, we see that students are starting to favor working at companies that have a much broader, better mindset on these issues. So there's the employee piece, and then you have, and I think what's happened with COVID in the last 9 months is there's a bigger focus on what you're doing with your communities, what you're doing with your supply chain, what you're doing with your healthcare. So these are you know, it's you're taking the Milton Friedman thing that, you know, the social purpose of business is to make a profit, maybe, but to make a profit, there are so many other things that need to be factored in. And if you're going to make a profit, even if you accept that for a second, and because there are a lot of folks who still believe that at HBS too, by the way. So we have, as we should, we're an academic institution, so we have enormous debates on this topic. That even if you believe that that is the purpose of profit, you have to actually measure profit in an appropriate manner. You cannot measure profit on anything that comes as income, but all the expenses and the costs that you're throwing out in the world are not factored into that profit. It's as simple as that. So take that profit motive, and that's where I think Uli mentioned this whole issue of our impact-weighted accounts initiative that we're doing at HBS, which is exactly that, which is measure the cost of doing business and charge companies for the cost of doing business. If you are emitting tremendously and not dealing with that problem, that is a cost of doing business, and you should be taxed for it. And it should be factored out. The social purpose of doing business is making profit. Sure, but let's measure profit correctly. What is the profit that you're actually making? And then let companies and investors value you accordingly. So I think that's where we're going. I mean, I think I'm very much believer in capitalism and everything else, but I think it needs to be tweaked in terms of how we measure and manage it.
What you are referring to when you are talking in your class or interview about value and values, and I guess this is what you are answering to people who tell you that ESG investment is great, but well, ESG compliance is coming with a big overlay of inefficiencies, and therefore this is why ESG companies still do not outperform the market in pure financial terms. This is how you are addressing the question.
Well, not really. No, I think that's not true. Actually, but it's a good question to provoke me. So thank you.
That's our job, Vikram.
I think the way I think about values and value are two different ways, and is that there are family offices and where it's your own money, and a lot of these negative screens and things like that is an expression of values, which is that, hey, look, if I don't want to invest in tobacco stock, or I don't invest in alcohol stocks, or I don't invest in stocks which go against my religious beliefs or against my whatever belief, I'm not going to invest in it, and I really don't give a damn about the negative, if any, financial implication of that, because it's my money. I don't have a fiduciary obligation to anybody but myself. And that's where the family office kind of thing comes in, and it's kind of critical. But when you go to where the most of the money is in fiduciary assets, like pension plans, endowments, etc., or asset managers who are managing money on the behalf of these kind of fiduciary asset owners, you can't express your values. I mean, it goes against the principles right now of what the law is. Now, the law could change, and that's different. But in my mind, the value argument is equally important. I mean, if you are a pension plan owner and you are investing through funds or investing directly, and for example, one of my clients is the Canadian Pension Plan Investment Board, when they talk about a quarter, they're not talking about 90 days. They're talking about like 25 years. That's a quarter for them. And if you don't actually factor in climate risk, the risk of poor governance, the risk of how you operate your employees and your community, all the ESG factors into your analysis, you probably are making bad investment decisions. So this is nothing about, hey, I'm trying to do good for the world or whatever. And maybe it is doing good for the world, but that's not what this is about. This is about making better investment decisions. And what has been very hard traditionally is how do you actually incorporate good governance into your kind of financial projections? Or how do you even make the assessment? How do you factor in, what's going to happen with climate 20 years from now, what the implications are for, both your transition risk and your physical risk in the investment you're going to make? And so that's where I kind of get in the value that actually, if you are smart and figuring out how to actually do that, it's going to be a fabulous risk management tool. A lot of firms are doing that. But equally, it could be a massive alpha generation opportunity, which is that you identify companies that are doing this well and go after those. And it's not necessarily reflected in the stock price of those companies or the value if they're private companies, and go after them. And I think ETF is, while you're focused more on new technologies and stuff like that, that's part of the game here, right? Is to really figure out, who gets it? Who gets it that this is not about doing good. This is about good investing. And so I think that's where I distinguish this values versus value. It's very hard for a fiduciary to be talking about values. You saw that in the Department of Labor thing right now, where they said you can't factor in, things which are non-financial. And my response to that when they came out in June was, yeah, true. But actually, if you are a pension plan and you don't factor in climate and some of these other things into your investment analysis, you actually are violating your fiduciary obligation. So I think those are, in my mind, I know a lot of family offices, $1 billion plus multifamily offices. I'm sure there are a lot of LPs and ETF who fall in that category. They don't want to invest in certain categories. They're not going to do some financial analysis about it. They just don't want to invest in it. And that's fine, because that's their money. But I don't think pension plans and endowments and all can actually go down that path.
Hey, Vikram, I have to ask your Department of Labor comment. In 2 months' time, you think the rules are going to start to change? New administration?
Well, I think clearly the mindset of the administration, it's been clear. Biden's made that they're going to go back to the Paris Accord and really become part of the whole fabric of addressing climate change, as opposed to being, on one side of the whole discussion. But if I look at, and this may be controversial, but if I look at the final ruling of what the Department of Labor came out with, so they came out with something in June, which basically said, you can't factor in anything that's non-financial in your analysis. And the reason, my understanding, speaking to a lot of them over there, is that clearly, it's the administration kind of pushing it. But if you just kind of forget all that and just be clinical about it, is that there's been this massive increase in ESG products, huge, and people can make a lot of arguments about greenwashing and everyone just ESG to raise more assets under management. And their concern was that suddenly this will become one of those things where trustees would say, oh, well, we want to do good and let's put all these ESG products in there and like stop thinking about these things because that's like the kind of fad of the day, if you will. So I can understand where their concern was coming out to bring it up, which is say, look, ultimately you are a fiduciary and you got to figure out, what makes sense as a risk-adjusted return for your pensioners, as opposed to, investing based on your personal beliefs or on some policy objectives. And I actually totally subscribe to that. The problem with that ruling, or at least the initial thing, was that you have to totally ignore everything that has to do with non-financial issues. And they bucketed non-financial issues as ESG. So the fundamental, and I'm a academic and all that, so I don't want to get into politics, but the fundamental issue with bucketing ESG as non-financial is that that's ridiculous. It is actually fundamentally financial. If you, like I said before, ESG needs to be translated into your financial statements because poor governance can destroy a company. We've seen that multiple times over the last 5-10 years. If you're investing in a company which is, has all its commercial real estate assets on the coastline of Florida, you got to factor in climate as to what the implications of that asset value are going to be. So all these things. So is that's that's what we wrote back. And so what they came back with was actually not that wrong, which is that, you got to be a fiduciary, not factor in non-financial things. But if you think you need to factor in ESG aspects because it kind of is important to making but they still call them non-financial, which I have a problem with because these are not non-financial. But that it's important to factor them into, your longer term asset valuation decisions, you can do that. So quite honestly, I'm not sure how much of that can actually change. What needs to change and what may change if the new government comes in is that still trustees are very concerned about sticking in ESG funds, like we are doing a 401k, is that putting in an ESG fund or something which says ESG or climate oriented, et cetera, into the options. Because if that fund underperforms, that they potentially could be liable, like, hey, you put this fund in there because, it wasn't for financial reasons, but because you were trying to do, some other social reason, which is not, again, true. But, people are risk averse in America, particularly with all the litigious nature, and there have been a bunch of lawsuits and this and that. There was another, I'm not sure whether you saw this, but a lawsuit in Australia, which was filed by a pensioner. It just came out 2 days ago. A pensioner filed a case against the Australian pension plan saying, you guys did not factor in climate into some of our investment decisions and you violated your fiduciary obligation. And the pension plan lost that lawsuit.
You talked a little bit about the types of assets that we could be investing in. A lot of people were rejecting certain areas, like fossil fuel investments, et cetera. But The Economist in the last couple of weeks was encouraging us to invest in venture capital, particularly venture capital that was focused on sustainability-oriented initiatives, because they saw big opportunities there and the chance for big returns. Now, this is a bit of a self-serving question, of course, but what do you think of venture capital to help tackle climate change?
I think it's a huge opportunity. I mean, I think venture capital actually has been not that successful. Let's talk about climate transition, right? So just given, if you look at the cycle of venture capital, significant, and that's why a lot of funds and all that have been set up in the venture capital side, which are longer term, maybe not have the 7-8 year time horizon that you guys have. because the belief is that to really kind of focus on technologies that truly move the needle, that we're going to have a much longer time period. And, where you all would invest would be taking things which are somewhat proven and trying to figure out how to scale it up. And in that case, typically in the energy side and the energy infrastructure side, you need a lot more capital than, what you'd be willing to do on a $3 million, $4 million kind of investment per transaction. So I think it's a bit of an enigma for classic venture capital in the whole energy transition space, because on the one hand, the risk is very high, but then when it's de-risked, the amount of money that's required is significantly too much for you to actually do. So rather than this being, let me ask you, how do you think about that? Because I'm trying to learn this too, as to how a classic venture capitalist kind of plays in this whole climate transition, which is a massive opportunity, but at the same time, is this in the middle between being too risky and then when it's de-risked, needs too much money, and you just kind of, you can't play in the middle over there.
See, this is the problem with Harvard Business School professors. You ask them a question, they turn it right back on you. So it's been my experience there. But no, in all seriousness, I think you're absolutely right. You take companies that have already proven something out, and then you try to scale them, right? So to take pre-revenue risk is a big ask sometimes. You also look for sectors and segments that don't require a lot of capital. As you were saying, you don't really want to be in the energy generation space where creating an electron costs you a lot of money, and every electron looks the same, right? Why not go find spaces where you can find some differentiation and back some winners there. This is why we have the tagline of SMART in a lot of what we try to do. The smart city, smart industry, smart energy, because we're not trying to play the capital intensive game, but willing to, work with entrepreneurs that are doing some very clever things, around some of those assets. Remy, do you want to add something?
Yeah, in fact, I would challenge you, Vikram, to find any area of lack of sustainability in this world that we should not address through innovation. And to give you an example that is kind of counterintuitive, back to your point on the power production generation, you may know that there are about $100 billion that is put in a big project for nuclear fusion, the holy grail of electricity production, which is, by the way, 50 kilometers from where I live in France here. But at the same time, you have 5 startups around the world funded by guys like Bill Gates, Jeff Bezos, Jack Ma, so not anybody, funded with a few $10 or $50 million, and that are targeting the same objective of nuclear fusion. So again, I think that we are absolutely legitimate to get the ball rolling. Then, obviously, at some point,
I totally agree with you, Remy. So when you talk about breakthrough energy ventures, or again, these are so-called family offices that are decided that this is important to them, and they probably have a longer-term time horizon. But a classic LP GP fund, I'm not saying you necessarily are that, have a tougher time doing it because the time horizon is much longer and the potentially risk profile is higher. Am I correct? I stand to be corrected. I'm just trying to learn.
Look, I think you're correct for a lot of assets that are out there. I'll put in a sort of a vote of support for the team here. That's why we've been doing it for 14 years, right? You have to pick and choose where you can go and find the returns and the impact, right? I think that for newer groups, it's more challenging because you can get suckered into capital-intensive projects or projects that are going to take a long time. And so I think the other thing is that the imperative that was sort of put forth on the last panel is, we don't have a lot of time, right? We need to find stuff that rolls very quickly. And maybe that's sort of
but I find, I don't know what you guys think, but I think COVID has... there are not a lot of, it's hard to talk about silver linings of COVID, just given the devastation that it's had. But if you had to kind of identify some of the positives, I think this massive move towards digitization, whether it be ed tech, health tech, agri tech, fintech, and clean tech. I mean, the fact is that what would have happened over the next 5 to 10 years has been compressed in 9 months, which is absolutely phenomenal. And I think it will benefit the world in a tremendous manner. And, obviously we need to get through the COVID thing, which is a catastrophe. And I think the other thing is the realization that, what I was saying before, that this whole issue of the tragedy of the commons, that it's not our problem, but it's everyone's problem, and we don't really care. People realize that, in health, in climate, you can't be wearing masks and have social distancing and clean your hands, and that the problem will kind of not go away, but the problem could be contained. Yeah. Climate cannot be contained. And so I think the realization that and how people are coming together, I find in the last 2-3 months has actually been very, very promising.
I think the pandemic is obviously incredibly serious and awful for many people, right? The one bright thing it has done, it has encouraged people to take action about things that are in front of them. And what I mean by that is, people for a long time were saying that there is a chance for a global pandemic. Frankly, nobody did anything about it, and then it occurred. Those that have been warning about climate change, I think are taken much more seriously today because of the pandemic. The other thing that's very interesting about, I think, the pandemic is, certainly during the first lockdown here in Europe, people are willing to change their behavior.
Yes.
They change their behavior overnight. And one of the criticisms you always hear about those that are pushing sustainability initiatives is who wants to change, okay? And you see overnight a society willing to change. So I think, people understand that they can take action today and they need to take action today, and that's going to bode very well for a lot of entrepreneurs. Sorry, Remy.
No. In fact, I was about to say the same, which is that it's quite reassuring in the sense that when we are facing extraordinary threats, we can see that we are able to take extraordinary measures and to adjust very quickly. And in that sense, it is comforting for what is ahead, because what is ahead is 100 times bigger than COVID.
Correct.
And I want to ask you the next question I had in mind, given that you have been an impact policy advocate for long and teaching as well for a few years, do you see the right change of mentality, the right change of mindset with the people, especially the students, the next generation who will take power, that you would like to see at the speed at which you would like to see it?
No, I think I am, and I think it's so. If I look at the constituents, Remy, like this, there are three buckets here. There are a lot of the courses the course that I teach is really from an investor lens, which is how we wrote the course on ETF2 and your investment in e-leather and how we kind of deal with it. But there's the investor piece, there's the corporate piece, and then there's the regulation and the government piece. And the fourth bucket are the individuals, the citizens of the world. And I think in each one of them, there is an enormous increased momentum on trying to come. And I don't think any one of these four can actually solve the problem. They all four need to come together. And they need to reinforce each other through incentives, through push, through aggressive action, whatever it may be. So it's a combination of the stick and carrot on all four. And I think the investor community is I'm just looking at the last 2-3 years. You can still criticize people for greenwashing and marketing and all this other stuff. But I think you're generally having a lot more interest on the part of the investor community, particularly because they're long-term oriented. This move towards passive investing, that by definition, I'm a passive investor. I own the market, so I got to do something about this. I can't just sell stocks. So there's a big push on the investor side. We talk a lot about in our class. I'm seeing, and COVID actually, so if I did interviews with boards and CEOs like a couple of years back, climate was important. A lot of them people got it much more than others. But in the last 9 months, the ESG factors like front and center on board discussions and management discussions. And I think where people are moving towards is also not just talking about it, but linking incentives and compensation and all that to some very critical ESG kind of metrics. And I keep G separately because G's, sometimes I wonder why ESG is all together, because they're not. So keep G separately. So keep in the E and the S, and S particularly in the last 9 months. So that's the second piece. And I think, we talked about in the previous discussion about regulation. Europe clearly is ahead of the curve. If you have a change in government here in the US, you probably see more of it. We do need to have some regulation which requires some consistent disclosure, whether it be the impact weighted accounts initiative kind of thing that we're doing at Harvard or whatever it may be. It took 100 years for FASB, and it will take time for so-called SASB or something similar like that to happen here. But having some sort of regulation which requires consistent disclosure, and it doesn't have to be across all the same disclosure across all industries. What I like about SASB and some of the work that we've done at Harvard, along with George, is that each industry has got 5 or 6 material ESG fact things that matter to the company. So let's just focus on those. And SASB has done a great job of breaking that down. And from a regulation standpoint, if you just focus, this is what you need to disclose, it'll help enormously. I mean, you change behavior based on what you measure. And I think the fourth is the consumer and the students and everything else. Massive momentum that I clearly see on campus. So I'm generally an optimist. And as I said, the COVID has obviously been a catastrophe and it's, had such negative things on taking lives and negative health implications and seriously negative economic implications. But I think if you look 5 years from now, you could look back and say, hey, look, there are a lot of things that happen in terms of behavioral change in this time, which are going to help us in the long run.
Vikram, we're coming up on the half hour. So I think with that, we should end the webinar. I just want to point out that when I was at Harvard Business School, there were 5 of us that took the environmental class, of which only 2 of us were business school students.
Yeah, I'll say on that, we've just launched, just for the benefit of the audience, we're doing they have these new short intensive programs at Harvard, which is like 4-day things, which we implemented 4 or 5 years ago on a specific topic that may be of interest. So George Serafim and I, we decided to do a short intensive program on climate, financing climate in January. It was sold out, and we actually had to cut it off because they don't take more than 75 students per class.
Well, and Vikram, that's what I was going to say. 5 when I did it, literally hundreds that are doing it today, which is both a comment on how important this issue is, and frankly, how good the teaching is. So, well done, Vikram. Many thanks for joining us. And,
thank you for having me. Thank you, Remy. Thanks for
anybody needs Vikram, find me. Sorry, Remy.
No, I'll join next session, Vikram, as a student, and maybe as.
Oh yes, please. You're most. Next time we teach the ETF case, because we teach the ETF case, and Rob always comes as a guest. So you please come as a guest too. We'd love to have you.
All right. Many thanks, everybody, for joining. Take care.
Thank you. Take care.
Thanks for listening to this episode of the Sustainability Talks podcast. To find out more or join as a guest, head over to the ETF Partners website at www.etfpartners.capital. You can also connect with us on LinkedIn or follow us on Medium at ETF Partners. So until next time, thanks for listening.